Hello everybody, Dave Ceruolo, real estate probate and elder law attorney. Today we're going to be talking a little bit about capital gains and what you need to understand when you're dealing with the whole issue of capital gains. Stay tuned. Good afternoon, folks. Today what we're going to be discussing is capital gains. Now when you first have to understand the whole idea of capital gains tax, you got to understand some basic concepts, okay? Now we're talking about the sale of your home. First off, when you have investment property or rental property, there is always an issue of capital gains. And for investors that have that type of property, there is the possibility of doing a 1031 exchange. That's a whole different animal, folks. So when you rent or you have investment property, there is always a capital gains issue. There is no exclusion, okay? And you have to understand that and understand the whole idea behind 1031. Maybe I'll do another video down the line on that. What we're going to be talking about today is the sale of your home, your primary residence, the primary place where you reside, where you show on your tax return as being your home. And so when we talk about capital gains on your primary residence, first of all, you understand that for an individual, you have a capital gains exclusion of $250,000, and if you're married and filed jointly, your capital gains exclusion is $500,000, so it doubles. All right. So the first concept we need to understand is your basis. Now the basis is your starting point, and what you have as a sale price, which might be today's price. Okay, there's a gap in between usually your starting point and your sale price. So let's say you bought your house back in 1984 for $100,000, and today you're selling your property for $500,000. Well, your starting point is $100,000 back in 1984, folks. That's your basis. And what the accountant's going to look at is any improvements that you put into your house. The improvements are going to increase your basis, and so we're going to shrink this margin in between your present sale price, which we said was $500,000, and your starting point, which we said was $100,000. We want to shrink that margin in between. So anything that you did to your house, you're going to report to your accountant, and they're going to increase your basis, and then we're going to shrink this area in between, which is your gain. All right? So your gain is anything above and beyond your basis. Now your purchase price is what you're selling for. And so what the accountant will do is once you have your sale on your primary home, the accountant will take a look at your closing disclosure form. It used to be called a settlement statement, and factor in some other expenses into your sale price and potentially shrink this margin even more. A good accountant would do that for you. Now, what are some of the qualifications that you need to have a $250,000 or $500,000 capital gains exclusion? Folks, this is just in general. There are some other qualifying factors to receive your $250,000 capital gains exclusion. But in general, you need to have lived in the property for 2 of the last 5 years. You can't have rented any of the property. And if you do rent the property, let's say you live in a 2-family, you reside in one of the units, well, the accountant has to take that into consideration. You'll get your exclusion, but it'll only be on half the sale, folks, because it's a 2-family and you rented the other portion. Remember, there is no capital gains exclusion for an investment portion of property. What else do you need as far as a qualifying factor? Well, the sale can't be above $500,000. If it is above $500,000, doesn't mean you don't get your exclusion, but there is going to be some capital gains exposure there, potentially. All right? So now what we talked about is your qualifying factors. You have to live there 2 of the last 5 years. Okay? You can't have rented a portion of the property in general, and your sale can't be above $500,000. Now, when you meet the rest of the qualifying factors, you are entitled to a capital gains exclusion. So that means, well, in our scenario, our purchase price in 1984 was $100,000. Our present sale price is $500,000. That means that there's a $400,000 gain. We're going to add in any improvements to increase the basis. Let's say that was another $75,000, $100,000. Now you increase your basis from $100,000 to $200,000. Your starting point would be there. Your sale price would be $400,000, okay? Or $500,000, let's say. So you would have a $300,000 gain at that point, and so you would potentially have a $50,000 capital gain that's going to be taxed. And what is the rate on capital gain? Well, the rate is anywhere up to 20% of your gain. So it can be pretty substantial. So in this way, we're going to understand what capital gains is all about. And I hope you enjoyed this. And I will see you next time around. If you are watching YouTube, make sure that you click the subscribe button, because every time I post a video, you're going to be able to see that, and you want to make sure you subscribe. If you're watching Facebook, then make sure that you visit my page and like the videos that are there if you enjoy what we do. All right, I'm Dave Ceruolo. Thank you for watching.